All right, hi everyone. Welcome to today's webinar brought to you by Vantage, where today we're taking a look at the central bank spotlight and with the focus on the Federal Reserve. All right, we're streaming directly into the Vantage app as well as over Zoom, so do not hesitate to drop your questions in the relevant Q&A boxes as we progress through today's webinar. All right, before we begin, please take note of the disclaimer. Right, the information, context, and opinions which are expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage and are solely used for educational purposes as they do not constitute investment advice and or consultation on how a client should trade. Also take note of the risk warning that comes with trading margin, forex, and CFDs as they carry significant risk and is not suitable for all investors. Right, my name is Ketan Ramachandra, and this webinar series is brought to you in a special partnership between Vantage and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so here's the agenda for today, right? So basically, the Federal Reserve held its latest monetary policy meeting in June, right? The meeting is a two-day meeting, which commenced on 17th of June and ended on the 18th, right? So that's when the Fed statement was released, followed by Chairman Jerome Powell's press conference as well. Now, we are continuing to see Powell come under significant pressure from US President Donald Trump to cut rates as well. So there's a lot of factors at play here. We've got external pressure from the president. We've also got tariffs, tariffs policies, uncertainty surrounding tariffs policies, as well as inflation continuing to remain quite persistently sticky as well. Not a very easy situation or position for the Fed to be in at the present moment. Now, we'll start off by looking at the key takeaways from the statement, right? So the statement was released at 6 p.m. GMT on 18th of June, right? And as widely expected, right, the Board of Governors voted unanimously to maintain the federal funds rates in the target range of 4.25 to 4.5%. So no surprises there, right? It was widely expected that the Fed was going to hold rates, and that's what they did for the fourth consecutive meeting this year. So take note, the most recent meeting that took place in June was the fourth FOMC meeting, and where they kept rates on hold once again. Now, this follows three successive rate cuts in late 2024, beginning with a jumbo rate cut of 50 basis points in September, 25 basis points in November, and another 25 basis points in December. Right. Now, with regards to economic data, right, and GDP growth and imports and exports, right, due to the implementation of tariffs, right, and rollbacks as well. And that has created a lot of uncertainty, and that has also resulted in a lot of swings in export and import data in March and in April and May as well. So generally, the swings in net exports have affected the recent data. However, recent indicators still suggest that economic activity has continued to expand at a solid pace, while the unemployment rate remains low in recent months and labor market conditions also continue to remain solid. Right. Uncertainty, of course, surrounding the economic outlook, right, has diminished but remains elevated, right? As we all knew back in April and May, the economic outlook had completely been uh, brought into disarray due to the implementation of high tariffs being levied against major trading partners such as China, the EU, Japan, Canada, and Mexico as well. There's a lot of, since then, there's been a lot of trade frameworks that have been agreed upon, although nothing official has been signed off just yet. Remember, it'll take months before any official trade deals get signed off between the US and any of its major trading partners. But in the meantime, we have seen some concession take place via trade deal frameworks and the rollbacks of certain tariffs, as well as the current ongoing 90-day suspension as well. Take note, this 90-day suspension is expected to expire on 9th of July, basically next week. And the way things are moving with regards to trade negotiations is very likely we could see an extension of this 90-day pause. Now, whether this will result in another extension that would last 90 days as well, then waits to be seen. But given the pace of trade negotiations and the complexity, right, this is something that can't be resolved in just a couple of months. We're going to need a lot more the nations involved will need a lot more longer time, and that's probably going to result in another suspension of probably 90 days once more. Right. So although the uncertainty around the global, not only global U.S. Economic outlook, but domestically as well in the U.S., it has diminished, but nevertheless it remains elevated, primarily driven by trade policy concerns and geopolitical risks as well, especially with the recent escalation, uh, rather the recent conflict between Israel and Iran over the last couple of weeks. But uh, that has been sort of put on hold due to the ceasefire that has been broken for the time being. Now, higher tariffs, as expected, right, were cited as a factor contributing to stagflationary revisions in economic projections, with PCE inflation projections adjusted higher for 2025. Right, in the March projection, it was expected to be at 2.7%, at an annual rate of 2.7%. But in the most latest projection, which was for June, we are now expected to see headline PCE coming in at an annual rate of 3%, while core PCE is expected to reach an annual rate of 3.1% versus the 2.8% projection back in March. Now, in addition, the committee will continue to reduce its holdings of Treasury securities, agency debt, and agency mortgage-backed securities as well. Right, so basically, this is the opposite of QE or quantitative easing, right? And this is a process, right, that's known as quantitative tightening, right? They're removing some liquidity from the financial markets by reducing its holdings of Treasury securities, agency debt, and agency mortgage-backed securities, right? By slowing the pace of decline of its security holdings by reducing the monthly redemption cap on Treasury securities of 25 billion to 5 billion, right? This is somewhat reducing the pace of quantitative tightening, right? They were doing it at a higher redemption of 25 billion per month, but that has been reduced to 5 billion. So that means they're removing less liquidity from the markets, right? So in essence, they have sort of slowed down the pace of QT or quantitative tightening. And on the other hand, they are maintaining the monthly redemption cap on agency debt and agency mortgage-backed securities at $35 billion per month. Now, the next meeting will take place on 29th to 30th of July, which is in about 4 weeks, less than 4 weeks from now. Now, a quick conclusion or summary of the statement, right? So the statement basically reaffirms the Fed's steady hand approach, holding rates at 4.25 to 4.5%, while highlighting solid economic growth, a stable labor market, and slightly elevated inflation. Right, of course, it continues to signal growing unease about tariff-driven stagflation risk, with stronger language on increased uncertainty and dual risks to inflation and unemployment. Right, it represents a significant shift toward a more guarded and risk-aware stance, right, reflecting the Fed's response to evolving trade policy challenges. Right, the Fed is uh, after making three successive rate cuts at the end of 2024, right, the Fed is adopting a wait and see approach and would like to see how uh, the evolving trade policy challenges are going to impact inflation, the labor market, and economic growth as well before deciding to pull the trigger with another potential rate cut. Right, so the meeting concluded with a cautiously neutral stance as expected, balancing upgraded inflation forecasts against growth headwinds while prioritizing data-dependent flexibility. Now, after the statement, which was released at 6 p.m. GMT, Powell commenced his press conference as well, half an hour after the drop of the statements at 6:30 p.m. GMT time. Powell began his press conference, and these are some of his key remarks during this from that event. Now, touching on economic resilience, right? Once again, during his press conference, he emphasized that the economy is in a solid position, with labor markets at or near maximum employment, and of course, inflation still continues to remain somewhat elevated. Right? Remember, the Fed's target sits at 2%, right? And with PCE projections for 2025 being upgraded or being revised higher, right? It's a step away from the Fed's target of 2%. Right? Remember, headline PCE, as we saw here, right? Headline PCE is now projected to come in at an annual rate of 3% for 2025 versus the initial projection of 2.7%, while core PCE is expected to reach the annual rate of 3.1% versus the original projection of 2.8%. You can see it's a step away in the wrong direction, from where the Fed targets it, right? The Fed has an inflation target of 2%. Now, with regards to policy flexibility, right? He stated that, of course, the Fed is well positioned to wait, right? The adopt and wait approach is something that's being touted by Powell since the beginning of the year, right? They're waiting for clearer data before adjusting policy, underscoring readiness to respond to emerging risks due to, of course, trade policy uncertainties, as well as any further escalation in geopolitical conflicts in the Middle East. Now, tariff effects, right? He acknowledged tariffs would likely raise prices and slow growth, but he's probably expecting it in the near term, nothing that would last beyond 2026 or 2025, but expressed confidence in avoiding persistent inflation if expectations stay anchored. Now, there was also uh, some level of discontent between Fed members, right? There's in recent weeks we've started to see diverse views emerge from the board of governors within the Federal Reserve, right? So when questioned about divergent rate cut projections among members, Powell attributed these differences to forecasts in a foggy time and varying risk assessment. So although there is some certain level of disagreement with the direction of future rate cuts. Nevertheless, the uh, Powell still is in charge, and he seems to have still is able to yield influence over most of his members as well, right? The FOMC members. Now, on a question pointed to Powell with regards to artificial intelligence, right? Specifically on with respect to the labor market, right? So Powell noted uncertainty about whether it would augment or replace jobs, calling it transformational, right? Calling AI transformational, but it's still too early to quantify, right? And there were also talks of comparisons to the 1970s because that's when the last stagflation or the most recent stagflation period occurred, and that was back in the 1970s. However, Powell dismissed these parallels, stating that at the present moment, the US is less dependent on oil, right? The US has actually almost gained total independence with regards to US, with regards to oil dependence, as they've now become the world's largest producer of crude oil, right? And Fed also, and Powell also reaffirmed the Fed's unchanged policy framework as well, right? So he seems pretty confident that they are able to avoid the stagflationary environment as what we saw in the 1970s, which was nearly 60 years ago now. Now, what can we conclude from the press conference? Right, it's pretty much nothing new from the prior FOMC meeting that took place in May. Right before June, we had May as well. Not much. There's not much new information to glean from the statement or the press conference as well, right? So once again, the Fed, of course, is going to remain cautious and data dependent, emphasizing patience before making any policy changes. Powell also highlighted that the US economy is in a solid position, right, with labor markets remaining strong and inflation somewhat elevated, but showing some signs of improvement. Right, he has made it clear several times, not only during this press conference, but at any other appearances and interviews. He has made it well clear that the Fed is well positioned to wait for more definitive data before adjusting interest rates, right? Before adjusting interest rates, reflecting a commitment to flexibility in response to evolving economic risks, right? And also stress that while tariff-related uncertainty and inflation pressures continue to persist, the Fed is confident in its ability to keep inflation expectations anchored and does not see the current environment as comparable to the 1970s stagflation period. Right. Also, overall, the message was one of measured optimism and a continued focus on balancing risk to both employment and price stability. Right. So you can see here, after making 3 rate cuts at the end of 2024, the Fed has paused for 4 consecutive meetings in 2025. Right. So you can see here, widely in line with expectations. Right. The Fed kept rates on hold at 4.25 to 4.5% as well. Remember on Forex Factory, right? The figure that is stated here refers to the upper band of 4.5%. Right, so the statement was released at 6 p.m. GMT, followed by the press conference, which began at 6:30 p.m. GMT. What was the immediate reaction in the dollar? Right, you can see here, this is the 15-minute chart for the dollar index. And at 6 p.m. GMT time, or 1800 hours, the initial reaction in the dollar was to sell off, right? The dollar index was hovering around 98.70. It dropped as low as 98.45 before stabilizing around 98.55 and then continuing and started to climb higher as the press conference got underway. On a 1 hour time frame as well, you can see that by the time we wrapped up the third week of June, the dollar index had initially climbed higher, right? But and before reaching as high as 99.40 in the final week of June. But since then, of course, we've seen the US dollar lose value once again, right? The US dollar has seen intense selling, right? It has fallen out of favor for both investors and traders alike, and the dollar index itself has lost, I believe, now almost more than 12% since the middle of January. Now, how will President Trump try to influence the Fed's decision-making process? He's already made it very clear that he doesn't like Powell. He wants Powell to cut rates. And the longer Powell holds out, the more it's going to infuriate Trump as well, right? But once again, right, apart from making his opinions and feelings clear on social media or on traditional media interviews, right? There's not much Powell can do, right? There's not much Trump can do, right? As the Fed operates as an independent institution, right? If Trump does try to do something over the top, right, that would really undermine the credibility of the Fed, and that would cause the US dollar to lose even, that would cause investors and traders to lose even further confidence in the US dollar, and not only that, but also lose confidence in US Treasury bonds as well, right? So any attempt by Trump to try and undermine Powell and try to undermine the Federal Reserve is going to come at a huge cost as well, right? But however, there are still some ways that Trump may try to influence the decision-making process of the Fed, right, through indirect mechanisms, right? Of course, this includes public pressure, which we all know what that he's capable of doing very vocally via traditional media outlets as well as social media platforms, right? So including public pressure, of course, trying to change appointments to the Federal Reserve Board and policy actions that shape the economic environment. However, the good thing is the Fed's institutional design and legal framework limit direct presidential control. So that's a very important point. That has been in place. Now, public pressure and rhetoric is nothing new from the Fed, from Trump, but Trump has always had a history of publicly criticizing the Federal Reserve, and particularly since since the end of last year and this year, right, criticizing Powell himself. Right, even during his first term, he frequently called for lower interest rates to stimulate economic growth. Right, public criticism from a sitting president can create political pressure on the Fed, even though it operates independently. Now, of course, Powell has continued to emphasize that all decisions are based on data and not political considerations. Sustained public scrutiny can still affect perceptions of its actions. Right, appointments to the Federal Reserve Board, right? Trump may try to alter some members of the Federal Reserve, right? And he can do that because he has significant influence over the composition of the Reserve Board of Governors, right? So he's able to nominate new members and the chair as well, which is Powell's position. But of course, this is all subject to Senate confirmation. Right, if vacancies arise during this term or during his term, Trump could nominate individuals who align more closely with his economic philosophy, such as favoring looser monetary policy or prioritizing growth over inflation control. Right, for example, during his first term, Trump appointed Powell as Fed chair and nominated other individuals who shared his preference for low interest rates. But we can see now how the tables have turned, and now they are on the opposite sides of the coin. Now, economic decisions as well, right? Trump's fiscal and trade policies could indirectly pressure the Fed by altering the economic landscape, right? Fiscal policies such as the tax cuts or increased government spending, which is now with the focus all on the one big bill trying to be pushed through the Senate and Congress by President Trump, right? This could boost economic growth in the short term, but also increase inflationary pressures while widening the trade deficit as well, right? And this could, in hand or in a way, try and force the Fed to adjust its monetary policy stance. Trade policies as well, tariffs and trade disputes can raise costs for businesses and customers alike, contributing again to higher inflation while potentially slowing growth, creating a complex environment for the Fed to navigate. And by shaping these external factors, Trump's policies could influence how the Fed approaches its dual mandate of price stability and maximum employment. Right, legislative proposal or structural changes, right? This is very unlikely, right? This is very unlikely and would backfire if Trump did try to go down this line, right? It would look very bad on him and his entire administration if they were to propose any changes to the Federal Reserve Act or its mandate, right? This is very likely to backfire on them in a big way, right? Not only on him, but the entire administration as well. Right? He could advocate for a single mandate that's focused solely on economic growth rather than balancing growth with price stability, or he could push for greater executive oversight of monetary policy decisions. Right? However, such changes would face significant legal and institutional resistance, and even if forced through, it would look very badly on all of them. Now, what does it mean for the Fed moving forward, right? So basically, with regards to developments on the trade tariffs, right, we can see, right, since middle of May, several frameworks have been agreed upon between the US and its major trading partners, right? There was the first sign of de-escalation in the trade wars when this framework between the US and UK was announced on 10th of May, right? Once again, remember, this is not an official trade policy that has been signed off or trade deal that has been signed off, but more of a framework with most of the important points being listed. Nevertheless, it will take months before an actual trade deal is signed off between the US and UK. Similarly, between US and China as well, there were constructive trade negotiations that had taken place in Geneva back on 10th and 11th of May, right? And we had the announcement on 12th of May where these trade negotiations had resulted in substantial progress. But once again, this is more of a framework, right? A trade framework rather than the outright trade deal uh, and, and policy and agreement as well. Right, looking at inflation, right, we can see based on the latest results, right, back a couple of weeks ago, back in June, we had results for May, in consumer inflation results for May being released. So we can see here on the left, we have the chart for headline CPI at an annualized rate, and on the right, we have the chart for the core CPI. Now, headline CPI, right, accelerated in May, right, after decelerating from January, right, after climbing as high as 3% back in January of this year. Inflation moderated significantly lower, headline CPI falling to 2.3%, while the core as well dropped from 3.3% in January down to 2.8%. Core readings have remained unchanged since March. However, now we are seeing headlines CPI accelerate in May, right? One of the reasons, of course, is the implementation of the universal 10% tariffs that the US has levied against its major trading partners, as well as energy prices rising as well, right? We've seen crude oil prices surge in April and May, and that has also factored into headline CPI readings as well. Remember, core CPI does not include energy and food prices, right? Whereas headline CPI is going to incorporate these two categories as well. Hence, we are seeing an increase in we saw an acceleration in headline CPI. Similarly, for PCE, right, the Personal Consumption Expenditure Index, this is the Federal Reserve's preferred gauge of inflation, right? Headline PCE had decelerated as well from February till April, right, falling from 2.7% down to the annualized rate of 2.2% in April. Core PCE had decelerated as well, falling down as low as 2.6% in April as well. However, both of these data points then accelerated in May, right? So we can see here for a brief period of time, or at least in the first quarter of this year, we saw inflation trending in the right direction, trending closer to the Fed's target of 2%. But now we are starting to see the latest data start to move in the opposite direction, while we're also starting to see the projections indicate higher readings as well for 2025, and we are now expected to see headline PCE increase to 3%, while core PCE is expected to increase to 3.1%, right? Both of which projections are higher than anything that we've seen over the last 12 months. Right. When we look at the level of prices, right? By in the ISM reports for both the manufacturing and services sector, right? We can see here this is the prices index for the manufacturing sector in orange or gold, sorry, and we have the prices index for the services sector in blue. Right? We can see here prices were somewhat under control in 2024, right? But now we see the sharp acceleration or higher prices in raw materials for the manufacturing sector, as well as higher prices for services as well, right? And when we plot uh, the average of these two prices in these two price indices, right? Take note, the average. We can calculate the average of these two price indices, which is the line in red. And we are starting to see ISM prices average, remember the line in red, has started to accelerate once more. And typically, once prices in the wholesale sector, right, which is basically these two indices, right, start to accelerate, of course, those costs eventually get passed on to the consumer as well. For now, those costs have yet the costs borne by the producers, right? The higher cost pressures faced by the producers have not been passed on to the consumers just yet, right? But perhaps this is something that could cause CPI to accelerate further in the next couple of months. Remember, ISM prices average, right, which is the red line, has a lead time, is a leading indicator, right, with regards to where CPI can be expected to head, and it has a lead time of easily 3 to 4 months, right? You can see here, we can always see ISM prices average accelerate first, and then we see CPI start to follow suit 2 to 3 months or 3 to 4 months after. Similarly, as ISM prices average starts to decelerate, we can then see CPI follow suit after 2 or 3 months as well. This is very clearly observed between 2020 and 2024, right? When we saw ISM prices, the average of ISM prices accelerate, shooting up, hitting an average of nearly 85 or 90. And then it took a few months later before CPI started to accelerate sharply as well, breaking above the Fed's target of 2% and reaching as high as 9.1% by the middle of 2023. But then, right, we can start to see once again, ISM prices average start to decelerate first, and 2 to 3 months later, we see CPI following suit as well. So what you're seeing now is probably what we're seeing now for ISM prices average is something that's quite likely to cause to see consumer prices start to accelerate once more over the next couple of months, right? So this is the price pressures that uh, are expected to come in, right? Due to higher tariffs, due to the implementation of the 10% universal tariffs, as well as due to higher energy prices as well, right? Energy prices, especially in the last couple of months. All right, with that, now let's move on over to the charts and trading view and take a look at where the dollar index is trading. Right, we can see here, right, since middle of January, 13th of January, and even as by mid of June, right, in a period of 6 months, the dollar index had lost more than 11.4% or lost 11%. And as of today, right, we can see the dollar index dropping nearly 12.5%, right? The dollar continues to fall, continues to remain out of favor with investors and traders alike, right, due to the ongoing global trade uncertainty, due to the trade deficit also expanding higher, and that could all the trade deficit could even widen further should we see this one big bill that's being proposed by Trump be approved by Senate and Congress as well. Right, so you can see here dollar is selling off aggressively, right, and the dollar index has also dropped below the level of 97 quite convincingly. Right now, it's going to be quite a challenge to try and identify where the major support is, but nevertheless, we're going to give it a good shot. Right, we're going to zoom out and look where the dollar index was trading back in 2022. Now, one thing to note as well, despite the dollar index losing over 12% in on losing nearly 12.5% in 2025, right? It is still at somewhat elevated levels. So you can see here, dollar index was actually as low as 71.5 and 74 between uh, April '08 and July 11th, right? So you can see here nearly 14 to 17 years ago, right? The dollar was actually much weaker than what we are currently seeing, right? So despite seeing a drop of 12.5% in the value of the dollar index, right, we can see that it is still way quite away from its lows that was seen in February 2008, where the dollar index had dropped as low as 71, 72, right? Okay, so with that, let's come back to the daily time frame and try and see where we could identify uh, the next potential support areas for the dollar index. Is currently trading around 96.40, right, which is this um, red line here. And right, when I look at the chart for the dollar index on the daily time frame for January 2022, right, I can spot a nice, almost like a nice overlap level at around 94.60, right? We can see resistance being formed here in October of 2021, and then we see support being formed here in January of 2022. So this looks to be a pretty decent overlap that we can probably identify as the first support for the dollar index. Right, so this level sits at 94.56. Oops, actually it might have, wait, has it? Okay, no. Yeah, that's right. Its dollar index is currently trading at 96.42, and the first major support sits at 94.56. Now the second major support uh, could be this overlap as well. It's another pretty decent overlap at 93.30, right? We can see resistance being formed here, swing high resistance being formed here in March of 2021, another swing high resistance here in August, and then swing high resistance here as well in July, some resistance here in September, all in 2021. And then you see November as well, we see a nice bounce taking place here as well. So we also have another pretty significant overlap at 93.30, which we can label as the second support. Now coming back to where the dollar index is trading, we can see the first support sits a pretty far distance from where it's currently trading. But nevertheless, you can see that uh, dollar index has been trading within this downward channel since middle of May. Right? You can see here since 12th of May, the dollar index has been trading within this downward channel. Right, and for now, it looks to be no real bottom in sight. However, this downward channel has been respected since 26th of May. So perhaps we could see some consolidation around the lower trend line on the downward channel over the next couple of days. Right. On this zigzag pattern here, there's a nice zigzag pattern beginning from 29th of May, going down to 13th of June, and then from 23rd of June, right, nice zigzag pattern here. On this type of market structure or pattern, we can run a Fibonacci projection, right? So the Fibonacci projection will begin from point 1, 29th of May, going down to point 2, 12th of June, and ending at point 3, 23rd. And when we look at all the projection levels, we can see the key. Okay, hang on. Right, key projection levels sit at 61.8%, 70.6%, and 100%. Right, we can already see, of course, dollar index has already exceeded the projections at 61.7, 61 and 70.6%, where it looks to be currently testing now or trying to break through is the 100% projection. So let's keep an eye on the 100% projection, right? Because this could be this intersection of the 100% projection and the lower trend line of the downward channel, right, could prove to be an area where we could see the dollar index sort of stabilize as well, right? Let's see if there's anything else that we can try to do to identify any intermediate support levels, right? There's an uptrend here that begins from 12th of June. On this uptrend, we can run the Fibonacci retracement from the swing low on 12th of June going up to the swing high on the 23rd. The purpose of running this retracement is to look for key projection extension levels, which sit at 127. and 161%. Now we can already see the extension at 127% has already been broken. However, the extension at 161% actually aligns very well with the Fibonacci projection at 100%. So what we have here is a Fibonacci confluence area that's currently being tested, right? Usually, confluence areas can tend to function as pretty strong support areas in this case, but given how the dollar continues to remain out of favor, right, this confluence level may not be enough to keep prices supported at least over the next 1 or 2 days here. Right, so despite seeing the dollar index trade within this downward channel, despite having this Fibonacci confluence, identify a potential support zone, basically the intersection of the lower trend line of the downward channel and the Fibonacci confluence, right? Perhaps this may not be enough to hold or to create some level of to provide a near-term floor for the dollar index. Right, in terms of resistance, right, we've actually seen the dollar index give way, right? It's actually broken through what I would say is a pretty decent pullback resistance level at 97.92. Perhaps this is one of those, or this is a level that we could use. But before that, I remember there was a area in March as well. There's a level in March as well. I think see, right? Yeah, there was a level here, right? A nice, almost like a nice multi-swing low level here at 97.76 that had been in place since March of 2022. Right, but this level has now given way as well. So we're going to identify the first resistance at 97.76, which is an overlap, which is a nice pullback resistance, right? We can see support here in March of 2022. We can also see a significant swing low being formed here in 12th of June, right? Just 2 to 3 weeks ago. And now once this major support level gave way on Wednesday, 25th of June, it is likely to function as a potential resistance. So that's how we've labeled the first resistance at 97.76. Second resistance is going to be this level here at around 99.32. We can see the dollar index has failed to climb above 99.35 convincingly since the 3rd of June till the 23rd of June for a period of 3 weeks. And that's how the second resistance has been identified. Right, now let's zoom on down to the 4-hour time frame. Right, and we can see here, right now a little bit more clearer, and we can see that, okay, if you're going to be, okay, let's just use the daily as the guide to draw the downward channel, and then we go to 4-hour time frame. We can see that the dollar index has yet to reach the lower trend line of the downward channel, so perhaps we could see it drop as low as 96.30 or maybe even 96.20 as well. So maybe this region is to keep an eye out here. So remember, right, I would not be trying to put out any aggressive shorts close to this area here, right? When price is approaching the lower trend line of the downward channel, typically it can stabilize for a period of maybe over the next day or two. And in some cases, it could even result in a very strong pretty strong counter trend rally, such as what we've seen between 26th of May and 29th of May. Even here, 10th of June till 24th of June as well. You can see here as price respected the downward trend line, as price respected the lower trend line of the downward channel. We saw the dollar index stabilize for a couple of days, right? And then after that stage, a pretty strong counter trend rally. Perhaps this is something that we could see here materialize as well over the next couple of days as well. We could see some consolidation around this zone, perhaps between 96.20 and 96.30, right? You could see some consolidation here around this zone for next couple of days. And that may even result in a strong counter trend rally. So we could potentially get a much better opportunity to go short on the dollar index, maybe by the end of the week or next week as well. Maybe at its earliest, you're going to be a bit optimistic. If there's a strong counter trend rally that's going to emerge, perhaps by the end of the week, we could get a potential better opportunity to go short on the dollar index, or maybe by early or middle of next week. Especially since this downward channel has continued to remain respected, right? Perhaps as the dollar index is falling Towards 96, this may not be the best time to put on any aggressive shots. Wait for it to make a counter trend rally, where you could probably get it at a better price as well. Now, coming back to the daily time frame, now we're going to look at the dollar index together with momentum indicators such as the RSI and stochastic oscillator. Right, when we look at it on the daily time frame, we can see now, as of today, both of these indicators are highlighting a oversold condition. So what's an oversold condition? That's when the RSI drops below 30. Currently, the RSI, take a look at these readings here for the RSI and for the stochastic oscillator. Right, currently for today, the RSI is at 26.95, while the stochastic oscillator is at 4. So when these two momentum indicators reach their lower thresholds, typically they signal a potential oversold condition. And what does that oversold condition mean? It means prices are likely to slow down, right? We shouldn't expect it to fall any lower and make a consolidate and probably find a near-term floor, consolidate, and maybe even result in a counter trend rally. The last time we saw oversold signals such as this was back in April of back in 21st of April, right? You can see here on 21st of April, the RSI had dropped as low as 33.7, stochastic oscillator as low as 5.82. Then after dropping as low as 97.76, on 21st of April, the dollar index stabilized at around 98.35 before staging a pretty strong counter trend rally. This counter trend rally was as large as 4.1%, right? So remember, as I said, right, this is probably the worst place to be putting on any aggressive shorts on the dollar index, right? As it is also approaching the lower trend line of the downward channel, we are also now beginning to see an oversold condition being highlighted by the RSI and the stochastic oscillator on the daily time frame, right? Remember, the most recent condition or similar condition that was last observed was on 21st of April. And then we saw the dollar index stabilize around 98.30 before rallying, rebounding as high as 102. And prior to 21st of April, there was also another oversold condition being clearly highlighted on 11th of March. Once again, RSI dropping as low as 25, stochastic oscillator dropping as low as 11th of March. Right, and here we saw a minor counter trend rally, right? So minor counter trend rally, just 1.4%, right, for nearly period of 3 weeks, right? Nearly period of 2 to 3 weeks before the dollar index finally resumed its downward slide. So take note, right? Price never goes up and down in a straight line, right? There's bound to be consolidation, there's bound to be counter trend rallies, and perhaps this is what is that's something that could happen over the next couple of days as well, especially right on the daily time frame. We're seeing a pretty clear oversold condition, and the last two that were observed were on 21st of April and 11th of March, right? So be wary of putting on any aggressive shots in this current environment, right? The better opportunity would be to look for a retracement to the upside, right? Before putting on any new shorts, right? You can see here on this downtrend that begins from 23rd of June, right? You can see, right, we've also have this first resistance level here at 97.76, and we also have 97.50 here, right? Let's just assume the dollar index does not drop any lower, right? Today's low currently sits at 96.37, right? Let's assume the dollar index doesn't make a new low. And if that were to happen, we can run a Fibonacci retracement from this swing high on 23rd of June going down to the lowest point of today, 1st of July. And when we look at all the fibs, we can see that there is a prior support level here, right? There's a prior support level here at around 97.13. And this level gave way yesterday, Monday, 30th of June. So what was a prior support level here can be a potential resistance, right? And not only is this level at 97.13 a pullback resistance, it's also accompanied by a Fibonacci retracement at 23.6%. So should we see a counter trend rally, and if we see the dollar index rise up, perhaps going up to this level here, right? If we can stall around here, maybe we get a better opportunity to go short. But remember, this downward channel has remained in place since 12th of May. So perhaps we could indeed see a pretty strong counter trend rally leading all the way up towards the upper trend line of the downward channel. So perhaps if we do see something materialize over the next 1 to 2 weeks, and we see the dollar index rally as high as 97.15 or 98, and if it does continue to respect the downward channel, we can probably get a better opportunity to go short on dollar index at this point here. Remember, at the same time, right, we may have a counter trend rally that's going to materialize, so we may have a near-term bullish bounce for the dollar index, right, and especially if it breaks through, right, this descending trend line. In fact, I would say there's another channel currently in place within the downward channel, right? You can see there's another downward channel here on the 4-hour time frame, right? So take note of this as well. We could use this as a guide for to get a better opportunity to go short on the dollar index. But for now, right, you probably trying to chase it aggressively may not be the best way forward, right? You can probably still try to short the dollar index based on today's price action. But yeah, nevertheless, do not be too aggressive with your trades with the shorts now, especially when we're starting to see oversold conditions being highlighted on the daily time frame. Right, so these are the key levels here for the dollar index on a daily time frame with the key technical levels as well, key support and resistances. And we've also spotted a significant or clear oversold condition based on the levels of the RSI and the stochastic oscillator. Right, so let's now take a look at the US 500 as well. Right, we can see that, right, after going through all the volatility of April and May, right, we've seen equity markets rebound strongly, and we've even seen US 500, right, make a new all-time high, right? So the US 500 is the instrument that tracks the S&P 500 futures, and prior to the most recent high, right, the, the prior intraday all-time high was formed on 19th of Feb, and that level was sitting at 6,146. Now we can see as of Monday, 30th of June, the latest intraday all-time high was formed at 6,215. Now, when price breaks out of this resistance barrier, remember this level at 6,118 was a prior multi-swing high resistance, with the first swing high taking place here on 24th of June, and the second swing high resistance taking place on 19th of February. Right, so what we have here is a prior multi-swing high resistance that got taken out, which could serve as a pullback support. Remember, as resistances get taken out, they could function as support levels. So that's how we will identify our first support for US 500 on a daily time frame. And this is sitting at 6,118.10. Now there's another pullback level here as well. We can see resistance, swing high resistance being formed here in 12th of June, and as US 500 takes out this level, it is likely to function as another pullback area as well. So that's how we've identified the second support for US 500. And now we can run a Fibonacci retracement as well. We can run a retracement from this uptrend that begins on 23rd of May, going up to the high of Monday, 30th of June. We can see the 23 and 38.2% retracements sitting pretty well with the first and second supports respectively. We can also run another retracement beginning from this swing low, 21st of April, going up to the high of Monday. For this retracement, we can see that none of the levels align close enough to the first or second, so that's fine. Right, so don't force the Fibonacci levels onto the analysis unless it's aligns close enough to a predefined resistance or support level as what we've seen here. Right, and between 21st of April and 23rd of June, we can also see a nice upward channel, right? You can also label a nice upward channel for US 500. So we have the combination of the lower trend line functioning as a potential support area. We also have two pullback levels at 6,118 and 6,034. Both of these pullback levels are also accompanied by Fibonacci retracements as well. Right, so should we see US 500 pull back towards this area here, maybe around 6,115, 6,110, right? And if it can stabilize around this level, it may be a better opportunity to go long on this on this instrument once again, right? After for those who may have capitalized on the bullish breakout, right? For those who may have capitalized on the bullish breakout since last Thursday, right? Uh, and those who may not, right? I would say, right, if you've not been able to capitalize on the bullish breakout, I would say wait for a better opportunity, and that opportunity may arise if we see US 500 pull back towards this level at around 6,110, 6,115, right? If you can pull back towards this level here and stabilize, we could see a nice resumption of the uptrend, right? As long as we continue to see um, further improvements or more positive news emerge on the trade negotiations, as well as seeing uh, second quarter earnings as well. Right now, as we roll over into July, which is the beginning of the third quarter, we are going to see companies begin to release their second quarter results. So, right, so we are approaching earning seasons for US corporates, right? So we're going to see the banks, the US major banks kick things off with earnings season for the second quarter as well. So should we see earnings prove to be coming in strong, right? If we see a strong set of earnings from the major banks, from tech, right? That could be the fundamental catalyst that could uh, that would help to provide further tailwinds for US equities as well, right? And combine that with uh, more positive news emerging from the trade negotiations, right? That could bolster, that would improve overall market sentiment, and especially if earnings continues to highlight uh, a good set of results for most of the sectors and most of the mega cap companies, right? That could help to keep the indices and the big single name stocks elevated as well. Now, in terms of resistance, how can we identify resistance? Remember, prices made the latest intraday all-time high on Monday, 30th of June. How could we possibly identify the next major resistance barrier? In such a case, we can rely on Fibonacci tools such as projections and extensions. Let's try with an extension, right? Once again, I can spot a nice zigzag pattern here, beginning on 23rd of May, going up to 11th of June, pulling back to 23rd of June, right? Nice zigzag pattern here. So we can try to run a Fibonacci projection from 23rd of May, going up to 11th of June and ending on 23rd of June, right? When looking at all the projection levels, we can see that the projections at 61 and 70.6% have already been exceeded, but not the 100%. So we'll just keep 100% here. So we have our first major potential resistance barrier at around 6,239. And for one more resistance barrier, perhaps we can run a retracement on this downtrend here from 11th of June, going down to 23rd of June. The purpose of running this retracement is to look for key extension levels, which sit at 127, 161%. All right, we can see these extensions have already been exceeded. Can't use them. That's fine. Perhaps you can use another projection, this time beginning from here, 21st of April, going up to 20th of May, and ending on 23rd of May. So let's take a look at all the key projection levels, 61, 78, and 100%. And we can see that 61.8% sits at around 6,284. So we can use this projection level as the second resistance. And of course, should we see this instrument continue to climb higher, right? And we can then use the projections at 78.6%, and of course the projection at 100% as well. All right, so that brings us to the end of today's webinar, right? Once again, thanks for tuning in to today's session where we took a look at the central bank spotlight with regards to the Federal Reserve, which held its most recent FOMC meeting between 17 and 18 of June, where they kept rates on hold once more between 4.25 and 4.5%. Right, this marked the fourth consecutive pause in 2025, and they have projected two rate cuts in the second half of this year. Right, but nevertheless, right, despite staying put in the first half of 2025, we've continued to see the dollar index. We've continued to see the dollar index fall rapidly, right? You continue to see the dollar index fall rapidly as investors and traders alike lose confidence in the value of the US dollar, right? And also they've also sold off US Treasury bonds quite hard as well, right? So we've seen bond yields remain elevated while we see the dollar index fall even lower. All right, so that's all I've got for you guys today. Right, thanks again for tuning in, and I look forward to catching all of you at the next session. All right, take care, everyone. Have a great trading week, and catch you all soon.